Bitcoin climbed 0.5% today, but gold lost over 5%. Why are risk assets and safe places moving opposite ways right now? Thursday, August 13th, 2026. Like and subscribe for daily market updates. Today's agenda: Market Snapshot, the gold problem, crypto whales buy fear. Up next, the gold problem. Let's look at the numbers you see on your screen. Bitcoin is up to $63,759.05 today. Ethereum gained a bit more, hitting $1,891. Solana jumped over 1% as well. But oil, it dipped below $84 per barrel now. Brent crude sits at $88.94, while crude oil is down to $83.12. The S&P 500 ticked up slightly, but the Nasdaq added 0.5% too. Gold dropped 0.6% to $4,442.70. The dollar index barely moved at 99.97. The 10-year yield is down just 4 percentage points today. So what does this mean for you? If you hold stocks, the Nasdaq gain feels good because tech companies are positive on prices right now. But if you have energy exposure, that decline hurts your portfolio value immediately. Gold dropping while Bitcoin rises suggests a split in investor mood. Some want growth despite high rates, others still fear inflation. Why is oil down? The Strait of Hormuz deadlock remains unresolved, yet traders ignore the war premium for now. That brings us to crypto whales buy fear. Gold traded at $4,427 per ounce before surrendering over 5% in value during this session. That drop is huge for you to watch closely today. Investors fled safety, even though inflation data cooled last week. Why did they run? Traders are betting on a pause in rate hikes by September instead of seeking immediate refuge in bullion. They ignore the need for actual yield generation right now. With July price increases already priced into the model, markets lean toward no further raising interest rates next month. This creates an illusion that rates will stabilize soon enough to support asset prices without it happening yet. However, gold must regain half its recent losses unless central bank policy shifts dramatically. If Treasury yields remain anchored near 4.68%, borrowing costs stay prohibitively high for small businesses facing imminent debt service payments. This financial pressure drags down demand for non-yielding assets like physical bullion as capital seeks higher returns elsewhere to offset opportunity cost. You might wonder why gold fails to hold steady when inflation drops. The answer is simple. Investors are aggressively chasing yield in bonds and stocks, while waiting on Jackson Hole for definitive policy signals. Do you see how this mirrors history? Safe havens underperformed during early rate cut cycles before available cash concerns dominated headlines again. Consequently, holding gold requires patience through this transition period or a willingness to accept unpredictable price swings until yields naturally decline enough to make non-yielding assets attractive once more, without external stimulus changes driving the market higher artificially. Which leads to energy stocks' struggle. $63,759 is the price of Bitcoin today. It gained a bit over 0.5%, while everyone else was nervous. This looks surprising to me, because inflation data came in perfectly as expected, yet whales are quietly accumulating right now instead of selling off panic. Top-of-cycle buyers finally capitulate here, but big money keeps stepping in at these levels. You might wonder why Bitcoin does not drop when gold falls so hard today. The answer lies in the specific drivers for each asset class. Crypto moves on its own available cash in the market cycle, while gold tracks inflation and rates directly right now. If you hold digital assets, this move suggests that fear is being bought rather than sold by smart money today. That changes things, because panic selling usually pushes prices lower before a rebound happens later in the week. Why are whales buying? Because they know regulation uncertainty drags down risk appetite globally speaking across borders worldwide, including small businesses struggling with debt service payments, monthly due dates approaching quickly soon. Yet available cash in the market remains available for crypto specifically. Here's tech stocks rally. Crude oil sits at $83.12 today, down slightly under 1%. Yet, energy stocks face mounting challenges driven by escalating global political uncertainty. This dynamic matters because oil prices anchor inflation metrics. Even after July's recent dip, the link remains strong. The Hormuz deal collapsed earlier this week as well. While energy sector stocks remain up nearly 15% year-to-date, this performance inadvertently keeps inflation data readings sticky right now, preventing consumer costs from declining rapidly under these conditions. For holders of energy stocks, today signals immediate pressure on quarterly earnings forecasts. You must watch your portfolios closely as fuel expenses rise for broader industries across the economy. Profit margins compress further under the weight of global political instability. Washington and Tehran are locked in a deepening impasse regarding Iran-US tensions. This conflict weighs heavily on investor mood, despite signs that inflation cooled last week. Traders react to breaking news with an hourly frequency now, positioning portfolios before tomorrow morning's open without waiting for definitive diplomatic resolutions. Do you remember the 2019 oil price crash? Similar Middle East threats triggered it then too. Markets overreacted to potential supply disruptions, even without actual tankers being threatened back then. Company earnings suffer from rising operational costs and insurance premiums alongside global political risk, while barrels hold value due to scarcity fears. Investors must recalibrate expectations for the sector's growth trajectory now. Political headlines will likely continue to decouple oil spot prices from energy equity performance until a clearer diplomatic horizon emerges or supply constraints physically tighten global inventories. On to yields stay high. The Nasdaq surged 0.5% to close at 26,588 points. That move offers immediate relief for portfolios heavy in technology stocks. This rally was not random. It resulted directly from inflation data shifting market expectations regarding Federal Reserve policy. The narrative has moved away from imminent rate hikes and now centers on a potential pause in September. You see markets pricing this change aggressively, even as attention turns to Jackson Hole later this month for Jerome Powell's key speech, ahead of an official rate change tomorrow morning in Washington, D.C. For tech stockholders, today's move validates the thesis that high inflation is effectively contained and may be a thing of the past. Historically, technology sectors benefit when interest rates stabilize, because their long-duration assets look less expensive relative to earnings compared to other asset classes. However, investors must remain vigilant against complacency. Will next week's earnings reports prove if current momentum is driven by genuine business strength or merely speculative fervor over future rate cuts? If companies cannot demonstrate resilient growth without the crutch of falling rates, those expensive assets could correct sharply once that speculation fades. Watch closely for increased M&A activity in the tech sector as borrowing costs stabilize. This boost to indices comes with integration risks for shareholders. Ultimately, while the path forward looks clearer than it did last week, sustainability depends on earnings that can stand alone without relying entirely on central bank policy, easing to artificially inflate stock prices higher. Now let's wrap up with what you should watch next week. The 10-year Treasury yield is anchored at 4.68% today, having slipped only 4 percentage points despite last week's notable cooling in headline inflation figures. This stubborn adherence to higher rates reveals a critical disconnect between transient price drops and the sticky core services sector that continues to drive wage pressures. The Federal Reserve remains in favor of higher rates because it fears premature easing could reignite demand-pull inflation before productivity catches up, effectively capping bond prices from surging lower. This mechanism creates severe second-order effects globally. Elevated borrowing costs force small businesses worldwide into a cash-strapped existence as monthly debt service payments become unmanageable against shrinking margins. The impact extends far beyond domestic borders. Developing nations are now teetering on the edge of currency crises later this year if central banks fail to provide relief or rate change toward dovishness soon enough. History offers a stark warning. Similar yield environments in 2013 and 2018 triggered sharp capital flight from emerging markets, causing sovereign debt defaults that took years to resolve. For homeowners holding adjustable-rate mortgages or carrying variable debt obligations, the implication is grim without a dramatic policy shift. Monthly payments will remain elevated for months rather than decreasing as previously hoped. Investors must recalibrate expectations immediately, recognizing that yield curves are unlikely to normalize quickly enough to rescue balance sheets vulnerable to rate shocks. The window for safe asset accumulation has narrowed significantly, forcing capital toward real assets or short-duration instruments where duration risk is minimized, before the next potential available cash in the market crunch hits global credit markets. Today's market action reveals a divergence between gold and Bitcoin, as investors increasingly price in a Federal Reserve pause by September rather than seeking immediate safety. While oil dips below $90 despite ongoing geopolitical tensions at the Strait of Hormuz, high yields near 4.68% keep borrowing costs elevated for consumers until central bank policy shifts toward dovishness later today. Meanwhile, Bitcoin appears to find support around $63,500 as large investors accumulate positions, suggesting a potential floor has formed despite broader uncertainty, affecting small businesses struggling with upcoming debt service payments globally. Thanks for watching Market Pulse Daily.